Are you thinking about investing in real estate rental? And you might be wondering if that's really worth it. Hi, I'm Matt Ahn, EA with Ahn Company. Today, we're going to talk about the key benefits of real estate investment, especially when it comes to tax benefits. Probably want to take some notes from today because that property viewing, the next one that you're about to do, might come with a whole new perspective. Let's dive in. The main benefit of investing in real estate is that you are considered as a business owner from the IRS perspective. Why is this important? Well, as a business owner, you get to write off your expenses. It's really important to understand those real estate investors are business owners, that you as a business owner is about to take profit out of your investment. It's not like when you're a W-2 employee where you have limited opportunity for tax deductions. Real estate investor as business owner can take tax deductions against the revenue their businesses generate. One of the common questions that I get is that what exactly can I write off? The answer is any expense that's ordinary and necessary for your business. The IRS publication 463 describes as an ordinary expense is one that is common and accepted in your business, and necessary expense is one that helpful and appropriate for your business. Again, it's you as a business owner who decide what expense is ordinary and necessary. The expenses in rental activities include your mortgage interest, your property taxes, utilities, repairs and maintenance, and your management fees, and so on. Now, let's talk about depreciation. It's an interesting area to discuss since it's one of the most significant benefits when it comes to investing in real estate rental. When you buy a property, the IRS assumes that it'll experience wear and tear over time. When it comes to residential property, you deduct your depreciation over 27 and a half years, which means under the rule of depreciation, you deduct a portion of your property's value, which could be your purchase price, that would be your basis, can be deducted every year over the next 27 and a half years. The beauty about this depreciation is that while you're deducting a portion of your property's value, your actual market value can be increasing. Compare this to stock investment. There's no depreciation, your stock doesn't experience any wear and tears, but in real estate, you get to have a tax write-off while your asset appreciate. I would say that's a win-win. Switching gears, let's talk about losses and see how they can help reduce your personal taxes. When you own a rental property, your rental activity generates income, which is your revenue. And from that revenue, you'll subtract your operating expenses, including your mortgage interest, utility, property taxes, and the key benefit, depreciation. And here's where it gets interesting. Your expense could exceed your revenue, and your business can show a loss. This loss can be used to lower your taxable income. Generally speaking, your passive loss can only offset your passive income. I'm going to talk about this example with you. When you had a rental activity that generates $5,000 loss, and you also had a partnership you didn't actively participate, but you still had that $2,000 of passive income in 2024, your $5,000 loss can offset this passive income that you had. So your taxable passive income will be $0, and the remaining $3,000 of loss carries forward indefinitely to offset your other passive income in the future. However, here's the good news. There are exceptions when it comes to real estate rental with active participation. According to the publication 527, when you actively participated, which means you made management decisions, you arranged services to provide in 2024, you may deduct up to $25,000 of your non-passive income, which means your W-2 income there. Let's just go back to the example. Suppose you had $50,000 of W-2 income. After offsetting your passive income, the remaining $3,000 loss, and remember that, they can now be used to lower your taxable W-2 income down to $47,000. To qualify the full amount, $25,000, your adjusted gross income needs to be $100,000 or less. What can you do with that money? Pay off your debt, or even reinvest it in another property as down payment to scale out your real estate business, right? I often hear this misconception from the clients that I talk to. Well, I only have one rental property that generates a small amount of income, so I don't need to really worry about the tax planning. Well, here's the thing. Your tax savings may not seem very big for now, but when you scale out your investment, which you're going to want to, then it's the snowball effect from there. As your rental income grows, so do your taxes. So knowing how to plan and strategically approach can really make a huge difference in the end to make your investment more profitable. So always best to consult with a qualified tax professional to get a personalized advice for your long journey of real estate investment. To sum up, number one, when you become a real estate investor, the IRS starts seeing you as a business owner, which means you get to deduct your expenses that are ordinary and necessary for your business. Number two, there's a depreciation. Over 27 and a half years for residential property, you deduct a portion of your property's value every year. You can still deduct as your property's market value goes up. Number three, don't forget passive loss. If your adjusted gross income is under $100,000, you can deduct up to $25,000 of your income. That includes your W-2 income. That's money you can pay off your debts, reinvest, or save for your future. You can find more information from the IRS publication 527. I'll have that linked in the description below. Okay, that wraps up today's topic. If you have any questions around your taxes, feel free to reach out. My contact info is in the description. If you find this video interesting, please like and subscribe. Thanks for watching.